going to review a stock called Shopify, and you can just type it in Google and click enter, and this information will appear for you. And you can see the name Shopify Inc. and the symbol is shop, and it's for 369.94 US dollars for one stock. And you can see, just scroll down and you can see it's a billion size firm, it's a big size firm, and there's no dividend yield. So I just want to point out that any firm that is paying dividend, that means they're financially very strong, because it's a positive news, because after paying their creditors, loans, liabilities, they still have extra money. That extra money it pays to shareholders as dividend. But this firm doesn't pay any dividend. So either it's not financially strong, or that it doesn't have money to pay shareholders, or it has money to pay shareholders but it chooses to reinvest in its own firm to further expand. There could be many reasons, but this aspect is very important to consider. It was founded in 2004. You can simply click Wikipedia, search this box, and see founded 2004, 15 years ago. And I'll just copy this exactly from Google. Copy this, paste here, and I'll see the reviews of the employees in Indeed. And let's have a look. So I can see that they have 42 reviews, 4-star, and it's read through the pros and cons yourself and check out the photos, the jobs listed, the question answers. Please look reviews in Glassdoor as well for this firm, which is important website as well. And click this thing and you can see that we have 505 reviews. It's 4-star. Read through the reviews yourself, check out the jobs listed, the salaries they're paying, the interview questions, and the benefits they're giving, the interview questions, the photos of the firm as well. And let's go to Yahoo Finance, and let's see that what key executives are getting, what are their salaries. That's very important for us to know. So I'll just click on shop, that is the Nasdaq symbol, go to profile, and I just want to show you one more thing. Please have a look at the sector, industry, and employees. And the best part of this firm is that all of the key executives has shown their salaries, so that's very important because we know all the salaries, so it's very transparent, and this enables us to build trust with this firm because we can see all the salaries. That's brilliant. Let's go to Justia patents and see if this has any patents or not. I'll just paste it exactly from Google, click enter, nothing appears. Let's remove ink and click enter, nothing appears. So this means that this firm doesn't have any patent. Any firm that has patent, that means they're very strong in the market. It's difficult to beat that firm, and it's very competitive. It has a moat, but this firm doesn't have any patent. Let's have a look at macro trend and let's see the ratios of this firm. Click price ratio, price book ratio, and just type in the symbol or the name or whatever. And I just want to explain you briefly. If price book ratio is less than 1, that means stock is cheap, it's undervalued, it's a sale. If it's more than 1, that means stock is expensive, and the higher the number goes, the more expensive it gets. So let's have a look. Be patient with this website because sometimes it takes time to load because it has a lot of data, but don't worry about it because it will make your life quite easy. So be patient with it, please. So I can see right now that it's 18.63. This means that somebody who buys in August 2019, they'll be paying nearly 18 times more money to buy this stock. It's 18 times more expensive. Somebody who bought in June 2019, they bought it 15 times more expensive because they paid $300 to buy something that was $19 worth. They paid 15 times more price. Right now, it's 18 times more expensive. If you see in 2018 December, it was 7 times more expensive because people paid $138 to buy something that was $18 worth. So they bought 7 times more expensive. And if you see that, I think the cheapest it was in 2018 March, when it was 7.98 times more expensive. People paid $124 to buy something that was $15 worth. So right now it's 18 times more expensive. So let's go to other ratios. I want to look at current ratio. If current ratio is less than 1, that means stock is risky because liabilities are more than assets. If current ratio is 1.5 or more than that, that means stock is safe and it has a good margin of safety. So let's have a look. Okay, I can see now that it's a lot more than 1.5. That's a good news. That means stock is very safe. Let's look at the previous trend. Has it ever been below 1.5? That's my question. So since 2013 December up till now, consistently it has been above 1.5. That means it's a very safe stock in terms of current ratio. I want to look at debt equity ratio. I'm looking for zero point 0.5 or less than that for it to be very brilliant, for it to be safe. This ratio will tell me if the company is mainly operating on debt or equity. Let's look at it. I'm looking for zero point 0.5 or less than that. Okay, so I can see that right now it's less than zero point 0.5. That means the stock is very safe. It has a good margin of safety. Let's look at the previous trend. Has it ever been above zero point 0.5? That's my question. So I can see that since 2015 June up till now, consistently it has been less than zero point 0.5. So it's a very safe stock in terms of debt equity. Let's go to return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. Right now, I can see that the equity return on equity is a minus, and I can see consistently it's a minus. So since 2014 December up till now, consistently it's a minus return on equity, and I'm looking for 8% or more than that. This is not the equity I'm looking for.